So another point which is very important is that the North is industrialized. You can see that the export to emerging country as the share of total export to emerging country is 12%, which means that a lot of export of Germany and the northern country towards European countries is still very high. Europe is still 80% of the trade balance of Germany. So speaking about an exit, voluntary exit of Germany is absolutely ungrounded. The explanation of that is, as you can see, cost. Unit labor cost difference, 25% differential in less than 5 years between the North and the South. And this can be explained for structural reason in Spain, because you had an increase in wages somewhere and it was spreading all over the countries. And on the other way around, in Germany, you had those so-called mini jobs and €1 jobs. So strong differences, and you can see that the recovery pattern is very interesting. Strong increase in production. The industrial production in the north is very close to where it was before the crisis. If I had Germany, we would be here. And if you look at where we stand for the south, it's still very low. So the question is, to what extent the south should make a strong effort, adjust unit labor cost, try to do a manufacturing base on probably producing goods that Chinese or even German do much better. It's really a very important question, and the very strong problem and the reason why, to me, the next phase of the European crisis is the following: no growth in the south and strong growth in the north. So there are several questions I will be able to talk about it, but the next challenges are clearly those ones. Whether we are able to have internal transfer, more population moves. It's not a question of whether it will be happening in the next quarter. But there is, of course, we need to solve the financial crisis, and it will be done. It will probably cost between 150 and 200 billion euros that will have to be shared between the public and the private sector, but after that is the economic model of the Eurozone. And as you know, the exit is absolutely non-sustainable. So this is public data. I could have any others. You can see the unemployment ratio that I mentioned before. So the question that I ask is this one. So I was a little bit, but that's the real question. I mean, it's really serious, because many people think, especially in the northern part of it, they just have to do like us. They just have to adjust their labor costs. They just have to. This is absolutely inefficient for any economist. I mean, we're supposed to have countries that export and work based on their comparative advantages. We have to make sure that those comparative advantages are done. But if you try, which was the case, if you leverage, you have a strong domestic demand to help one country, let's say Germany, to have a comparative advantage at the end of 5 years of strong adjustment, then you also have to make sure that you get something in compensation. And this compensation is just transfers. So I will go very quickly on that. Those charts, because I'm getting so prospect very quickly. So if you take all together, and once again this is the big question, because you know that the ECB is watching the entire area. Because if you look at the entire area, you have good reason to tighten. You can see, this is the current level of GDP growth, nominal GDP growth, that is inflation plus real growth. It will be close to 3% over the next 2 years. And you can see that there will be some strong incentive to tighten monetary policy. The ECB, Jean-Claude Trichet, will not do it. He's very aware of what's going on. But I think that we need to have a Eurozone with much more discrimination over the next year. You can see that the unemployment ratio here is expected, according to our economists, to remain quite elevated, which means that there is still also some kind of social risk. And now there is a question of the euro. There is a long term and the short term. Regarding the long term, I kind of like this chart, because you can see that the euro strength is really a matter of macroeconomics. As far as Germany, and to a lesser extent the Eurozone, has an external balance which is positive, you have a strong euro, because when you have an area which has a surplus, you don't supply the world with euro. So the currency is kind of short supply and the currency remain kind of strong. And it's really important to bear that in mind. So it explains the level of the euro pretty well. And this is our forecast because we have to show you the forecast. And what I told you before is that this is the sort of May, that is, it was the case of Greece. This is the Irish and its aftermath, and this is Portugal, Greece. But the euro will probably, and the market will also be disappointed by growth figure in Europe and probably the fact that the ECB will not tighten as much as it. But the euro has a long way to stay close to its. It will probably stay close to its equilibrium of 135, 140 over the next quarters. So I will go through that, and I think I am done. Thank you very much. If you have any questions.